Have you ever wondered why reports claim your wealth is growing, yet your credit card balance is flashing red? The Fed just released a staggering figure. The top 1% now holds a record $44 trillion. But while that sounds like an economic boom, for the other 90%, it's an invisible, suffocating trap. We're living through the era of paper wealth, where you look rich on a spreadsheet but struggle at the grocery store. Today, we decode the trap of the 1%. To understand why we're falling into this trap, let's look at the latest financial report from the Federal Reserve. On the surface, the numbers look fantastic. If you're part of the bottom 90% of American households, your net worth has actually climbed. In fact, total household wealth in the US is at an all-time high. But here is where the math gets dangerous. For the vast majority of people, that net worth isn't sitting in a bank account. It isn't liquid. It's locked inside the four walls of your home. As real estate prices have surged over the last few years, your home value went up. On a spreadsheet, you're richer. But can you use that wealth to buy groceries? Can you use it to pay for your child's tuition? This is what economists call illiquid assets. You have the value, but you can't touch the cash. And here is the lock-in effect that is paralyzing the middle class. A few years ago, you might have had a mortgage at a 3% interest rate. Today, rates have doubled or even tripled. So you're sitting in a house that is worth $500,000, a record high. But if you sell it to unlock that cash, you have to buy a new home at 7 or 8% interest. Your monthly payment would skyrocket, effectively wiping out any profit you made from the sale. You are, quite literally, house poor. You own a valuable asset that you cannot afford to leave and you cannot afford to spend. While the Fed's data shows the 90% getting richer, this growth is almost entirely driven by these frozen real estate values. It's a passive increase. It's wealth that exists only on paper. It creates a psychological illusion of safety. You feel wealthy because your Zillow estimate went up, so you continue to spend as if you have that money in your pocket. But look closer at the Fed's figures. While home values rose, the actual cash on hand for the bottom 90% has been shrinking. The excess savings from the pandemic era, the stimulus checks and the paused student loan payments have officially dried up. According to the San Francisco Fed, that safety net is gone. So we have a massive contradiction: record high net worth, but record low cash reserves. We're living in a house of cards made of expensive bricks. The 90% are holding on to assets they can't sell, while their daily lives are becoming increasingly expensive. This is the definition of a paper wealth trap. You are worth more than ever, yet you feel more broke than ever. And while the 90% are trapped in their houses, unable to move and unable to liquidate, the top 1% are playing a completely different game. They aren't waiting for their home value to tick up by 2% next year. They're holding the keys to the actual engine of the economy, assets that move, flow, and grow even when you're sleeping. To see the real gap, we have to stop looking at houses and start looking at liquid power. Because while you're locked in your 3% mortgage, the top 1% have never been more mobile or more powerful. Let's look at what they own that you don't. While you're stuck with your expensive bricks, the top 1% are dancing on the stock market. This is the fundamental divide that the headlines don't always explain. To understand the power of the elite, you have to understand one word: liquidity. In the world of the ultra-wealthy, wealth isn't just a number on a Zillow estimate. It's a tool. It's a weapon. According to the Federal Reserve's distributional financial accounts, the top 1% of households hold more than 50% of all individually held shares in public companies and mutual fund shares. Think about that for a second. While the bottom 90% have their wealth tied up in their primary residence, an asset they literally have to live inside, the 1% have their wealth in the engine of the global economy. They own the companies that raise prices when inflation hits. They own the technologies that are automating the future. And most importantly, they own assets that can be converted into cash in milliseconds. Here is the liquidity game in action. If a member of the top 1% needs $10 million for a new investment or a luxury purchase, they don't have to list their house on the market, wait 60 days for an offer, and pray the buyer's financing goes through. They can simply sell a portion of their stock portfolio with a few clicks.
Or, even more brilliantly, they can take out a low-interest loan against their stock holdings. They get the cash, keep their assets, and avoid paying capital gains taxes. They are playing a game of flow, while everyone else is playing a game of accumulation. You are collecting bricks. They are collecting economic energy. When the market is volatile, this liquidity gives them the ultimate advantage, agility. While the middle class is paralyzed by high mortgage rates, unable to sell their homes because they'd lose their 3% rate, the 1% can move their capital instantly. They can pivot from stocks to bonds, or from the US dollar to gold, or buy up distressed assets when the economy dips. They don't get stuck because their wealth isn't bolted to the floor. It's a sharp, almost cruel contrast. The bottom 90% are holding the shell of the economy, the residential neighborhoods, the cars, the physical stuff. The 1% hold the gears. They own the dividend-paying machines that generate cash flow regardless of whether the housing market is frozen or not. But it's not just about flexibility, it's about growth. Over the last decade, financial assets, stocks, private equity, and venture capital have outperformed residential real estate in terms of sheer wealth creation. Because the 1% own the vast majority of these assets, they aren't just growing faster, they are pulling away into a different stratosphere of compounding interest. So while the headlines tell you that American wealth is at an all-time high, you have to ask, what kind of wealth? If your wealth is a house you can't sell, is it really wealth, or is it just a very expensive liability? The 1% have solved this problem. They have decoupled their lifestyle from their location. They have ensured that their wealth is active, not passive. But for the rest of the population, the reality is much grimmer. Because while the 1% are optimizing their portfolios, the 90% are facing a much more immediate threat. Their liquid cushion, the actual cash they have to survive, is vanishing at a terrifying rate. We need to talk about the safety net that just got pulled out from under the American household, because the bricks might be expensive, but the bank accounts are starting to look dangerously empty. The bricks might be expensive, but the bank accounts are starting to look dangerously empty. While we've been distracted by rising home equity, a much more urgent crisis has been brewing beneath the surface. For the bottom 90%, the financial cushion that kept the economy afloat for the last few years has officially evaporated. Let's look at the hard data. During the pandemic, American households accumulated a massive mountain of excess savings, nearly $2.1 trillion, thanks to stimulus checks and restricted spending. It was a historic safety net. But according to the San Francisco Fed, as of early 2024, that entire mountain is gone. It has been spent. But here is the strange part. If the savings are gone, why is consumer spending still so high? Why do the malls and airports still look full? This is where the paper wealth trap becomes truly predatory. To maintain the lifestyle they grew accustomed to and to keep up with the illusion of wealth created by their rising home values, the bottom 90% haven't stopped spending, they've just started borrowing. We are witnessing a hidden collapse of purchasing power. According to Reuters and Oxford Economics, while the top 1% continue to grow their cash reserves through dividends, the rest of the country is pivoting to high-interest debt. For the first time in history, U.S. credit card debt has surged past the $1 trillion mark. Think about the irony here. People feel wealthy because their house is worth more, so they feel comfortable carrying a $10,000 balance on a credit card at a 22% interest rate. They are borrowing against a future they haven't realized yet. They are using plastic to bridge the gap between their stagnant wages and the skyrocketing cost of living. This is what economists call demand destruction in waiting. You can only run an economy on credit for so long before the interest payments start to eat the principal. The bottom 90% are effectively cannibalizing their future stability to maintain their current consumption. They are trapped in a cycle where they work to pay off the interest on the debt they took out because they felt rich, even though they didn't have the cash. It is a tale of two economies. On one side, you have the 1% whose wealth generates cash flow. On the other, you have the 90% whose wealth, their home, generates nothing but taxes and maintenance costs, while their daily survival is increasingly funded by MasterCard and Visa. This isn't just a lifestyle issue, it's a systemic vulnerability. When the excess savings hit zero, the margin for error disappeared. A single medical emergency, a job loss, or a further hike in interest rates doesn't just hurt, it shatters the illusion. We have to ask ourselves, how much longer can this go on? How much longer can a wealthy nation survive when its citizens are millionaires on paper but living paycheck to paycheck in reality?
The gap between the 1% and the 90% isn't just a gap in dollars, it's a gap in survival. But there is a way to look at this differently. If we can't change the Fed's figures, we can change how we play the game. To escape the trap, we need to stop acting like the 90% and start thinking like the 1%. It starts with one specific shift in how you view your own portfolio. So, how do we break the cycle? How do we stop being rich on paper and start being resilient in reality? To escape the trap, we have to stop viewing our primary residence as our greatest financial achievement and start thinking like a portfolio manager. The biggest lesson from the top 1% isn't that they have more money, it's that they have a different quality of wealth. They don't let their net worth sit dead in an asset they can't sell. They prioritize cash flow and liquidity. For the 90%, the goal has always been own your home. But in a high-interest, high-inflation world, your home is often a locked vault that costs you money every month in taxes, insurance, and interest. The shift starts with a simple but painful realization. Your net worth is a vanity metric. Your cash flow is a sanity metric. If you want to move toward the 1%, you need to diversify away from bricks and mortar. This doesn't mean you shouldn't own a home, but it means you shouldn't let it be 80% or 90% of your wealth. The 1% keep their primary residence as a small fraction of their total assets. The rest, it's in productive capital, stocks that pay dividends, REITs that offer exposure to commercial real estate without the lock-in effect of a mortgage, high-yield accounts that actually pay you to hold cash. The goal is to create active wealth. If the housing market freezes tomorrow, a member of the 1% doesn't care. Why? Because their dividend checks still clear, their private equity distributions still arrive, they have exit ramps. For you, the first step is building a liquidity bridge. Before you put another dollar into home renovations or extra mortgage principal, look at your liquid reserves. Do you have assets you can sell in 24 hours without moving your family out of their bedrooms? If the answer is no, you aren't wealthy. You're just a high-end tenant of the bank. We need to stop chasing the American dream of 1950 and